For nearly 2 weeks, the world watched the Middle East move closer to what many feared could become a much larger war. American bombers flew repeated missions. Iran promised retaliation. Military bases across the region went on high alert. Oil tankers changed course. Global markets braced for the worst. And then, almost overnight, everything changed. Oil prices, which had been climbing on fears of a wider conflict, suddenly suffered one of their biggest single-day declines in months. Billions of dollars disappeared from energy markets in just a few hours. So what happened? Did the war suddenly end? Did Iran back down? Or did something happen behind the scenes that changed the calculations of governments, traders, and military planners all at once? Because in today's world, wars are no longer fought only with missiles and fighter jets. Sometimes, the biggest battlefield is the global economy. And one announcement from Washington can erase billions of dollars from oil markets before a single new missile is launched. This is the story of why oil prices suddenly crashed after the United States paused strikes on Iran, and why this pause may be far more fragile than it appears. To understand why markets reacted so dramatically, we first need to understand what happened before the pause. For days, the United States had carried out a sustained military campaign against Iranian-linked targets. The stated objective was to reduce threats against U.S. forces and deter further attacks. Military aircraft, cruise missiles, intelligence assets, and surveillance systems operated across multiple parts of the region. Each new strike increased fears that Iran might respond directly, and history suggested that possibility couldn't be ignored. Unlike many regional conflicts, Iran possesses a large missile arsenal, powerful proxy networks, and influence stretching from Iraq and Syria to Lebanon and Yemen. Any large-scale retaliation had the potential to spread fighting across several countries simultaneously. That possibility alone was enough to alarm global investors. Because energy markets don't wait for wars to happen, they react to the possibility that wars might happen. This is one of the most misunderstood parts of global economics. Oil prices don't simply respond to current supply. They respond to expected future risk. Imagine you're responsible for buying millions of barrels of oil every month. If you believe supplies might become harder to obtain next week, you buy today. Millions of buyers making the same decision create sudden demand, and prices rise quickly. That's exactly what happened as tensions between Washington and Tehran intensified. Traders feared one possibility above all others: the Strait of Hormuz. Few places on Earth are as strategically important as this narrow stretch of water. At its narrowest point, the Strait of Hormuz is only a few dozen kilometers wide. Yet every day, a massive share of the world's seaborne oil passes through this corridor. Countries across Asia, Europe, and beyond depend on shipments that move through these waters. If shipping is disrupted, even briefly, the consequences can ripple across the global economy. Insurance costs rise, shipping rates increase, companies begin preparing for shortages. Fuel prices can climb thousands of miles away from the conflict itself. Drivers in New York, factories in Germany, airlines in Japan, they can all feel the effects of instability in this single waterway. That's why every headline involving Iran immediately attracts the attention of energy traders. As military operations continued, financial markets started asking difficult questions. Would Iran target oil infrastructure? Would commercial tankers become unsafe? Could regional allies be drawn into direct fighting? Would other countries intervene? Nobody knew. And markets dislike uncertainty more than almost anything else. The greater the uncertainty, the greater the price volatility. That's why oil continued climbing. Not necessarily because production had already fallen, but because investors feared production might fall. Fear itself became part of the price. Just when many expected another round of escalation, reports emerged that the United States had paused further strikes. The announcement immediately changed market expectations. It didn't mean peace. It didn't mean every disagreement had been resolved. And it certainly didn't mean military forces were leaving the region. But it suggested something important. The immediate risk of rapid escalation had decreased. For financial markets, that was enough. Within hours, oil prices dropped sharply. The so-called war premium that had been built into prices began disappearing. Not completely, but enough to trigger one of the largest declines seen during this phase of the crisis. For investors, it was a signal that diplomacy, or at least a temporary pause, might still be possible. That's where the story becomes far more complicated, because while oil prices were falling, military planners weren't celebrating. Naval forces remained deployed, regional bases stayed alert, commercial shipping companies continued monitoring every development, and intelligence agencies kept watching for signs that the situation could change again with very little warning. The pause reduced immediate fears. It did not eliminate the deeper conflict. In fact, many analysts argued that the region had entered one of its most unpredictable moments, because history shows that pauses in conflict can sometimes become negotiations, or they can become the calm before another escalation. To understand why investors reacted so quickly, you have to understand just how important one narrow stretch of water really is. The Strait of Hormuz sits between Iran and Oman. It connects the Persian Gulf to the Arabian Sea and, ultimately, the rest of the world. Every single day, millions of barrels of crude oil and other petroleum products move through this passage aboard hundreds of massive tankers. For countries like China, India, Japan, and South Korea, this route is one of the most important energy lifelines on Earth. If shipping slows, factories can feel it, airlines can feel it, power plants can feel it, and eventually, ordinary families feel it every time they stop at a gas station. That is why every military development involving Iran immediately grabs the attention of financial markets. Even if no tanker is attacked, the possibility alone can send prices soaring, because uncertainty has a price. For decades, Iran has understood one simple reality. It may not have the world's largest economy. It may not possess the world's strongest air force. But geography gives it leverage. The country's coastline overlooks the Strait of Hormuz, making it one of the most strategically positioned nations in global energy trade. Whenever tensions rise, questions immediately emerge. Could commercial shipping become more dangerous? Would insurance companies raise premiums? Companies reroute vessels? Could exports from Gulf countries slow down? Even small disruptions can create major ripple effects throughout the global economy. That is why investors constantly monitor this region. One of the biggest misconceptions about financial markets is that they only react to facts. In reality, markets react to expectations. Imagine hearing that a hurricane might hit a major oil-producing region. Production hasn't stopped yet. Pipelines are still operating. Tankers are still moving. But traders begin buying oil because they fear future shortages. Prices climb before anything actually changes. The same principle applies to war. When missiles begin flying, markets immediately calculate the probability of future disruptions. Not what has happened, but what could happen next. During the recent US-Iran confrontation, traders built what economists often call a risk premium into oil prices. That premium reflected fear. Fear that supply might be interrupted, fear that shipping costs might rise, fear that the conflict could spread beyond its original battlefield. Then, when reports suggested Washington was pausing additional strikes, part of that fear disappeared, and so did part of the price. But here's where many people make a mistake. A pause is not the same as peace. Military aircraft remain deployed. Warships continue patrolling regional waters. Air defense systems remain active. And intelligence agencies continue monitoring every movement. In other words, the infrastructure for conflict still exists. The difference is that political leaders may be choosing not to use it, at least for now. History has shown that temporary pauses can end in successful diplomacy. But history has also shown they can collapse within days. One unexpected missile, one attack on a military base, one strike against commercial shipping, and the entire situation could change again. That uncertainty explains why oil prices fell sharply, but not all the way back to pre-crisis levels. Markets are still pricing in risk, just less risk than before. When people hear about rising oil prices, They often think only about gasoline, but the consequences reach much further. Oil powers transportation. It supports agriculture. It influences manufacturing. It affects aviation. It impacts shipping. And because nearly every product must be transported at some point, higher energy costs eventually spread across the economy. Food becomes more expensive. Airline tickets become more expensive. Shipping companies pay more. Manufacturers face higher production costs. Businesses pass those costs to consumers. Inflation rises. Central banks respond. Interest rates may stay higher for longer. In other words, a military conflict thousands of miles away can eventually affect families almost everywhere. That is why governments pay such close attention to stability in the Middle East. It's not only about security, it's also about economic stability. When oil prices fall, some countries breathe a sigh of relief. Large energy importers, including many nations in Asia and Europe, generally benefit because they spend less importing fuel. Consumers may eventually see lower fuel prices. Businesses enjoy reduced transportation costs. Inflationary pressure eases. But for countries whose economies rely heavily on oil exports, lower prices can reduce government revenue. This is why oil markets are closely watched not only by traders, but also by finance ministries, central banks, and world leaders. Every major price swing creates winners and losers. The US-Iran confrontation isn't happening in isolation. The Middle East remains one of the world's most strategically important regions. Conflicts involving Iran often intersect with broader security concerns involving regional partners, global shipping routes, and international diplomacy. That's why governments far beyond the region are paying close attention. The concern isn't only about today's military operations, it's about preventing a situation where a localized conflict evolves into something much larger. Because once multiple countries become directly involved, the economic consequences become far more difficult to contain. For now, the markets have welcomed the pause. But one question continues to hang over the global economy. What if the fighting resumes? Military analysts often describe situations like this as high risk but low predictability. No one can say with certainty what happens next. If diplomacy gains momentum, oil prices could remain relatively stable. Shipping companies may regain confidence. Insurance costs could gradually decline. And global markets might begin focusing on economic growth instead of geopolitical risk. But if the conflict escalates again, the picture changes dramatically. A single strike on critical energy infrastructure, an attack on a commercial tanker, or direct military confrontation involving additional countries could push oil prices sharply higher within hours. Financial markets don't wait for confirmation. They react to expectations. And in today's digital world, those expectations can change in minutes. This isn't the first time the Middle East has shaken global energy markets. For decades, wars, revolutions, sanctions, and regional crises have repeatedly influenced the price of oil. Each crisis was different. Each had its own political background, but they all revealed the same lesson. Energy security is national security. Countries have spent decades building strategic petroleum reserves. Governments have diversified energy sources. Businesses have redesigned supply chains. Many nations have invested heavily in renewable energy, nuclear power, and liquefied natural gas. Not because oil is becoming unimportant, but because dependence on a single region creates vulnerability. Every major crisis reminds the world of that reality. This latest confrontation is likely to accelerate an already growing trend. Around the world, governments are trying to reduce their exposure to geopolitical shocks. Some are investing in renewable energy. Others are expanding domestic oil and gas production. Some are building new pipelines. Others are increasing strategic fuel reserves. The goal is the same: to make sure that a conflict in one part of the world doesn't immediately threaten economic stability everywhere else. Energy is no longer just an economic issue. It has become a strategic asset. And the countries that secure reliable energy supplies often gain significant geopolitical advantages. Most people assume financial markets are driven only by company profits and economic data. But geopolitics plays an equally important role. Every statement from political leaders, every military movement, every diplomatic meeting can influence investor confidence. That is why analysts study not only production numbers, but also satellite imagery, shipping traffic, military deployments, and government announcements. Sometimes, a single press conference moves markets more than an economic report. That's exactly what happened after reports emerged that additional U.S. strikes had been paused. The announcement didn't solve every problem, but it changed expectations, and expectations move markets. It's easy to become absorbed by numbers: oil prices, stock markets, military budgets, economic forecasts. But behind every headline are real people, families living in conflict zones, workers worried about rising prices, sailors navigating increasingly dangerous waters, businesses uncertain about future costs. Every geopolitical crisis creates ripple effects that extend far beyond the battlefield. Some are measured in dollars, others cannot be measured at all. Analysts believe the coming weeks may determine whether this pause becomes a longer period of de-escalation, or merely an interruption before another cycle of confrontation. Diplomatic efforts will continue. Military forces will remain alert. Financial markets will react to every new development. The situation remains highly fluid. And that uncertainty explains why investors remain cautious despite the recent drop in oil prices. The sudden fall in oil prices wasn't simply about cheaper fuel. It reflected something much bigger: a temporary shift in how the world assesses risk. For now, markets believe the immediate danger of a wider conflict has eased, but the underlying tensions haven't disappeared. The ships are still sailing through one of the world's most strategic waterways. Military forces remain deployed, regional alliances remain under pressure, and global leaders continue searching for a path that avoids a larger war. Because in today's interconnected world, a decision made in Washington, a response from Tehran, or an incident in the Strait of Hormuz can influence economies on every continent within hours. The missiles may pause, the headlines may slow, but beneath the surface, the geopolitical chessboard never stops moving. And as long as that remains true, the world will continue watching every move, because the next one could reshape not only the Middle East, but the global economy itself.